Time now for Alexander McDonald and his top picks here on his first day on Market Call. Chubb is number one, ticker symbol CB on the New York Stock Exchange, a giant of the U.S. insurance sector.
Yeah, so Chubb is a giant. It's the largest publicly traded property and casualty insurance provider in the world. It's a very well-respected management team. It's done a great job of operating it over the long term. When you look at something like their combined ratio, so that's an insurance-specific term basically on profitability, it's been consistently below 90 over the long term. So basically that means for every dollar they bring in insurance premiums, they're paying out less than 90% both in claims and expenses to sell those premiums. Great business providing commercial real estate, also has a high net worth, personal high net worth segment in the United States. We like holding it. Base valuation is about 10 times earnings. Price to book's about 1.5. We think that's certainly an attractive level. Yields about, they're reinvesting now with higher yields. What's coming off their books is about a 3.5% yield, and they're able now to invest in new fixed income products with the higher interest rate environment at up around 5.5%. So those premiums that they're bringing in from customers, they can deploy those into the capital markets and generate even more profits at attractive levels.
And your preference is for a big U.S. Property and casualty company over, for instance, a U.S. bank?
Yeah, Chubb's pretty international, actually. They do have U.S. exposure, but we do like their international exposure as well, too. In fact, they've been expanding more recently into Asia, and we like the growth prospects they have over there as well. We do own J.P. Morgan on the bank side, so we're not completely adverse to owning U.S. banks, but at these levels, as I mentioned, those valuation levels, we do like Chubb.
Okay, let's bring it closer to home. Brookfield Corporation, ticker symbol BN on the Toronto Stock Exchange, and a familiar name, of course. Most Canadian investors know Brookfield and the suite of Brookfield companies and publicly traded stocks. This one, however, is relatively new due to a restructuring at Brookfield. The ticker symbol is BN, and there you see it. And this is the parent, correct, of Brookfield Asset Management, a stock that most Canadian investors know very well? Yeah,
so Brookfield Corp owns a share of the infrastructure, Brookfield Infrastructure, Brookfield Renewable, Brookfield Business Partners, which is their private equity arm. It also owns part of the manager that Brookfield Asset Management also owns as well, too. So very well-regarded investor over the long term. They've been active, as I said, in all those areas. They now have an insurance arm that they're growing rapidly as well, too. Generated very good returns over the long term. Of course, now the one overhang that is pulling down the stock is concerns about commercial real estate exposure, specifically the office towers.
And how much of that is in Brookfield Corp?
So there is a fair amount in Brookfield Corp, but the market is actually giving it basically zero value at today's market valuation. It's less of a concern, the fundamentals of what Brookfield Corp owns, though, because they're more on the premium end of the office real estate. And what you're really seeing some of the deterioration in the fundamentals is from that lower end office real estate in the United States. And that's generally not where Brookfield plays. That said, there have been some headlines that it made. It's defaulted on a property in Los Angeles recently, and there might be a couple small ones like that we'll see in the future. But all the debt on that property, on those properties, is non-recourse to Brookfield, so it is just localized on those properties. Okay, interesting. Okay, let's go to another very familiar name to Canadian investors. We had a call on Scotia earlier in the show. Alexander McDonald's third top pick, Toronto Dominion Bank, ticker symbol TD. Yeah, so TD Bank, we do like. It has leading market share in Canada. It's the biggest alongside of Royal. Has done an okay job of cross-selling some of its customers who have deposits into other products like mortgages. We think there are some tailwinds for the bank doing a better job of that going forward. In addition, it has specified that with the new immigration coming into Canada, it does want to target more and more of these newcomers with the banking products that they need in their new country. Credit cards specifically, they've also singled out as an area of growth for them. In the U.S., of course, they had the First Horizon deal that didn't end up going through. So as a result, now TD has quite a bit of excess capital that it can do something with. It has specifically said that buybacks are something they're going to participate in. Maybe further down the line, in addition to the organic growth they're going to have with their retail network in the U.S., M&A may be a possibility. There was some regulatory concerns about First Horizon, so if they get on side with the U.S. regulators, we could see some M&A as well there too.
How long do you see TD carrying this excess capital before it does something?
That's the big question. They recently had an investor day. There were a lot of questions on that. People are pushing them on, are they going to do M&A? We're all just going to have to wait and see what management decides to do.
Okay, Alex, thanks a lot for this. We really appreciate it. We'll get back to those top picks on a later day and see how they have done in months ahead. Thank you for coming on today. Welcome back. Time now for top picks on this edition of Market Call here on BNN Bloomberg. Kim Bolton is our guest. He's an expert, of course, in the tech stocks. Top pick today, Advanced Micro Devices, ticker symbol AMD.
So this is a semiconductor stock, and you'll see a bit of a theme here still when it comes to generative AI. I remember sitting here, Paul, with Andy back in November of last year when we talked about generative AI, and it's still alive and well, and it's going to change our world. I think a lot of the market has got ahead of it, which is good for AMD, because NVIDIA, which is the king when it comes to the accelerators, and sort of in a layman's term, an accelerator chip is where you put a CPU together with like a central processing unit together with a graphic processing unit, GPU, and then putting in a memory in there too. And so NVIDIA did it very well for the gaming side. Then you remember you had that Ethereum merged last summer, and everything sort of dried up. But then all of a sudden this generative AI, which sort of lifted NVIDIA, and then you had AMD that was actually running with it. And so anyway, AMD has come out with very, very competitive CPUs, GPUs, and also accelerators. Now they're going to be coming out in 2024, which is only 6 months away, 5 months away. Mm-hmm. And NVIDIA, as they claim, that they're pretty well sold out for all of 2020, 2023, and 2024. So currently sitting at about 107.5. We have a 12-month price target of $131.20. We love this company.
Okay. Number two, ServiceNow, ticker symbol NOW on the New York Stock Exchange.
Yeah. So ServiceNow is, together with Salesforce, are the big guys when it comes into the software stack. And they're, it was founded in 2003. It went public in 2012. It has a great moat around what it has. So it actually develops cloud computing platforms that help companies manage the digital workflows for enterprise operations. It's key. And so the business becomes very, very sticky. And in fact, in that space, the total addressable market is anywhere from $200 to $220 billion out there. It's been teaming up, and a lot of companies like teaming up with it. So they've teamed up with NVIDIA, they teamed up with Accenture, the consulting side. They reported back on July 26th. They beat in the top and the bottom, and they actually extended their guidance. So, we think you can probably, pick it up here around 555, maybe down around another third around 530, and then the final third around 500.
Okay. Datadog is top pick number 3 on this day from Kim Bolton. Datadog's ticker symbol is DDOG on the NASDAQ.
Yeah. Again, this is part of that software stack in the whole AI. I always sort of talk about it, and I always refer to them as sort of the, so you have the software stack, and Datadog is like the lifeguard for the software stack pool. Mm-hmm. So it develops and monitors and analyzes solutions for development and operations and businesses. It's a software as a service company. So you're going to have, it's profitable. Actually, no, I'll take that back. It's going to be profitable come the fourth quarter of this year, which actually is accelerated from before. So Datadog's growth largely underpinned by the hyperscalers. The hyperscalers are the big cloud stocks. And so their software goes in, and the infrastructure as a service and platform as a service layers in there. So currently trading just shy of 90. And we have a 12-month price target of $107.75. I could go on and on about Datadog. I love this stock.
Okay. Well, thank you, Kim Bolton, on behalf of our viewers for all of your insight today. Welcome back. Time now for Greg Newman's top picks. Number 1 on this day is AltaGas, ticker symbol ALA.
Okay, so let me just go
Toronto
on.
Stock Exchange. Go ahead.
Yeah, I'm bullish. I'm more bullish than I'm not. But markets have had a huge move here, and slaying inflation down to 2% is going to take time. And so I'm being fairly conservative, and I think AltaGas sets up as a pretty conservative name. They continue to de-risk the balance sheet and their global export margin business. We're seeing very strong utility growth there. There's more deleveraging on the way, which is good news in this environment particularly. Lots of low capital, high return, midstream growth opportunities. Low valuation, around 11 times 2024, with about a 10.7% growth rate. A nice dividend, which we see growing at around 5%. So when you add it up, not that many ways to lose on this name with some nice upside.
And this is a natural gas infrastructure company. How would you compare it to some of the other pipeline names we've talked about here, Keyera, Enbridge?
So this is the thing. It really is the risk profile of a utility, but with the upside of the NGL midstream name. So it's a combination of both, and I think you get more upside but less risk than a Keyera.
Is it at all susceptible or standing to benefit from the price of natural gas itself?
Oh, yeah. So, their global export margins and their global export business, and building that out is a key theme.
Okay. Let's go to number 2, Chartwell Retirement Residences, ticker symbol CSH.UN on the TSX. It's a REIT, of course.
Yeah, so, the free cash flow on this name seems to be inflecting. Their last quarter was in line. Their same property net operating income was up 8.7. We think it's moving higher. Their retirement homes beat by 6%. The retirement home occupancy was up 70 basis points. The stock looks like it's in the middle of a turnaround, and this is usually a good time to be owning it. Reasonable valuation, 14.9 times price to adjusted funds from operation, and we are modeling 18% AFFO growth rate, 2022 to 2024. So sets up really well from a price to growth basis. I think seniors, are finally turning the corner here in Canada, Sienna as well. But this is the one that I like better.
And same question as I asked with respect to a pipeline operator, the macro interest rate environment. How material is it here to what is a distribution payer?
Yeah, listen, maturities really, really matter. And you have to look at their maturity, and their maturity profile right now is looking pretty good. But listen, you have to be cautious. If interest rates stay high or go higher, if inflation, does not do what we think it's going to do, then this might not be the best name to be owning.
Okay. And let's go to top pick number 3 on this day. We're going south of the border to Comcast, one of the big telco players and entertainment media distributors, CMCSA on the NASDAQ. Greg.
Gets no respect because it's thought of as a cable TV producer, which is really, a dying business. And But if you look at the business, the cable business already has very razor-thin margins, and it does have 6 growth businesses. It's got broadband for residential, broadband for business, wireless, theme parks, streaming, and studios. And together, those 6 businesses are growing at about 10% per year and will be 75% of the business over the next few years. So it's trading at a very anemic 11 times, and we're forecasting a growth rate of 10%. So I don't think this is a name in this. I'm a little bit pensive down here in this environment, and I think that this is a name that's not going to hurt you.
It's done very well over the past year, though, hasn't it? It's up about 15% over that period of time.
Yeah. Yes.
And you're still willing to buy at these levels?
Still see more room. Still believe that too many are thinking of it as a cable TV producer.
Okay. Greg, thanks a lot for your insights today. On behalf of our viewers, thanks a ton for answering all those questions. And thanks in particular to our viewers who put those questions to Greg Newman. Welcome back. Let's get to Gordon Reid's top picks on this day. Number one is Crane, ticker symbol NXT on the New York Stock Exchange.
Yeah, it's Crane NXT. And
Okay.
Crane split into two companies in March of this year, the old industrial and Crane NXT. And Crane NXT is their financial division. A lot of people didn't know about. They deal in on-site payment checkout devices. We use them every single day, multiple times, most of us.
These like tap devices?
Yes,
Right.
yeah. And they also have a currency division. Did you know that they have been the supplier of paper currency to the U.S. government since 1879?
As in printing the currency?
No, as in providing the paper.
Is that right?
For the
Okay.
currency.
Interesting.
And so they go back a very, very long time. And that's about a third of this new enterprise. Trades at about 13 times earnings. So it's relatively inexpensive. Enterprise value to EBITDA about 9 times, which is very good, very, very, very attractive. So we think there's a good runway. And a lot of times what happens, Paul, is that companies split off and it's almost like cutting a tree to expose a forest. You know, you can see more. And when companies spin off various areas of their operations, people have fresh eyes. They say, oh, you know, is this worth more? And as we saw with GE Healthcare, for example, in the initial stages, it was well received because people hadn't given it enough thought. And the same goes for Crane NXT.
Okay. Number two on this day, McKesson, ticker symbol MCK in New York.
Right, a very, very large distributor of pharmaceuticals in the United States. Great business. They grow, the earnings are growing at about 12 to 14% per year, revenues over 10%, and they're trading at about 15 times earnings. They've exited their European operations, so this is quite a pure play on a domestic company, and that's you know of quality of interest inside of a portfolio. It gives you a hedge against international exposure. So we very much like McKesson. You can see that it's down today. It's a bit of a sympathy play with what we talked about with CVS. And CVS is this whole situation has affected Aetna. It's affected United Healthcare, McKesson, Cardinal Health, AmerisourceBergen. All of these companies are down today in sympathy with the news.
Okay, we talked about that news earlier in the program, CVS losing a major customer in California. Uber Technologies is number three, ticker symbol UBER, very well-known stock.
Just bought it recently. They've, this quarter, become profitable. And I've been watching Uber for some time. I love the model. I wanted to see how management was able to convert the model into a profitable business. And they're very much on the right track. I think that they can take this. It's an asset-light type of model. I think of it a lot like Booking.com, which we've owned for many, many years, in which they're more or less just a middleman. If you think of Uber, they have the technology, the software, and they connect the passenger, the population, with the driver. And as a middleman, they make a cut. How can they build this into a very, very large business? They've got the model, and I think it's going to be a very exciting next 10 years for Uber.
What were you waiting for to step in here? You said you were watching it for a long time. Was it the transition into profitability?
It was. I really don't like to buy companies that are at an early stage and just trying to find their way and their footing without a keen eye on profitability. Because the market responds to profitability, it will grow tired of just the good idea.
Gordon, thanks a lot on behalf of our viewers for your time today.
Okay, Paul. Thank
Always
you.
good to have Gordon Reid with us. He's Chief Investment Officer and Chief Executive Officer at Good Reid Investment Counsel. He's an expert in U.S. stocks and shared that expertise with us today. Welcome back. Time now for top picks from Ryan Bushel. Top pick number one, and we've talked about a couple of pipeline stocks. One of his top picks, Pembina Pipeline, ticker symbol PPL on the TSX. Ryan?
Yeah, so again, we talked about a lot today, just where we think there's value, and a company like Pembina that processes a big chunk of the natural gas in Western Canada with volume set to increase. We think that's very positive for them as LNG Canada comes into focus here next year and into 2025, obviously. And there's an overhang on the stock, we think, potentially because they may or may not purchase some of the Trans Mountain project, if and when that were to come available. But in the meantime, the company's balance sheet is in excellent shape. The dividend is well covered and able to grow. And you're getting a 6.5% dividend yield while you wait. So you lock that in for now. You think about where that, the caller earlier on CNQ, like where could that be 5 years from now, 10 years from now, and where will the stock be if you can get there? So we think it's a good value at these levels, and think that these companies are not priced efficiently at the current time.
Okay, let's go to number two. We've spoken about another Brookfield company in this show as well. This one is Brookfield Infrastructure Partners, ticker symbol BIP.UN on the TSX.
Yeah, and so the thought process here is that it's come off recently alongside other interest-sensitive names with longer rates rising. But 80+% of their cash flows are either inflation protected or positively impacted by inflation, just given the businesses they have. The other thing that's maybe a little bit under the radar is their HVAC businesses are set to do extremely well here over the next couple of years. The government incentives in Canada and Europe on upgrading home efficiency are very positive for their Enercare and home HVAC businesses. So we like that going forward. And the spread between the infrastructure partners and the infrastructure corp shares is about $10, so nearly 20%, which we think is good value, especially if you can buy it in an RSP or a tax-free savings account. You're getting the stock basically 20% discounted to where the institutions are buying it. So think that has, should be positive and should put a bit of a floor under certainly the partnership shares, especially for registered investors.
What kind of track record does this company have in terms of increasing its distributions?
Yeah, dividend's been growing, 5 to 7% per year, very consistently, and think that can continue. I think it's a really unique Canadian asset. You've got a global footprint. You've got many different businesses underneath of that, and it's really well managed. So I think it's a good asset in anybody's portfolio. Okay,
and the final one will go to a major player in Canada's telco space, TELUS, ticker symbol T on the TSX. Why this one?
Yeah, so, and again, with all of these selections, we do think that there could be some choppiness in the fall, and choppiness is a nice way of saying downside. So, keep your eyes open on all of this. We're not buying anything today, but TELUS is now off to the point where we think on a long-term basis it should be accumulated. Their peripheral businesses, they're having some struggles there. But if you look at their core business, if we're going to keep adding, 500,000 to 1 million people to this country annually, that's subscriber loading on a network that's already built, both wired and wireless. So you've got a spectrum auction coming up. Yes, I know. You've got some tougher regulatory. Yes, I know. But you got a 6.4% dividend yield and ongoing population growth, which I think powers the stock from here. So you lock in 6.5% with, call it, even just 5% dividend growth for the next 5 years. I think you're going to be pretty happy with that on a long-term basis.
You referred to peripheral businesses having issues. I think you're referring to TELUS International, which is a provider of technology services to companies in that space. That has been a real drag on this stock. Why not Rogers or BCE, given this issue that those other two companies don't have?
Yeah, they just don't have as much exposure to that. I mean, the BC and Rogers, what they have is the media side, which has been a tougher slog for them. TELUS doesn't have the media side, and there's vertical integration synergies that come with the media side as well. So Rogers got their handful with the Shaw integration and all of that. BCE is kind of just ticking along, and TELUS to me is the one that's discounted the most out of the three relative to where it's at, which is they're further along on their fiber to the home build, so not as much CapEx there, a little bit more solid balance sheet. You're getting it based on these, like I said, peripheral businesses. They're going to have their ups and downs. Right now they're on downs, so that's the time to buy the stock.
Okay, and Ryan mentioned the media holdings of BCE and Rogers. Just a reminder that BCE, in fact, is the parent of this television channel through its Bell Media division. Ryan, I want to thank you a great deal, and in particular, our viewers want to thank you for what you've done today.
Yeah, thanks for having me. Appreciate it.